If you have recently sold any assets overseas, you would not want to miss this particular video. Hi, my name is Alan Leon and I'm a chartered accountant, aka FinNerd. Welcome to the FinNerd channel, where we bring you practical finance and tax tips to keep the taxman off your back. There has been a question on how much foreign tax offset you could claim if not 100% of the gains was actually taxable. So say, for example, you sold a piece of asset overseas, well, let's just say it's a house, and you paid $100,000 of tax overseas. Now, but back here in Australia, the sale is also taxable and also subject to a 50% CGT discount, meaning only half the gain is taxable. Now, would you be able to claim the full $100,000 as a tax credit, or is it only $50,000? By way of background, the purpose of a foreign tax offset is a means to prevent double taxation of the same amount by two different countries, by one country giving a tax credit on the tax paid in another jurisdiction. So the question has been the subject of a very lengthy dispute between the taxpayer and the Australian Tax Office, and finally we have a definite answer. The High Court in the last couple of weeks refused special leave to appeal from the full federal court decision in Burton's case. Oh, and by the way, I put the link to the case in the description below. Check it out. Now, the Burton's case deals with an Australian resident who has sold an asset held in the United States. Now, obviously, the sale of that asset has attracted US tax paid. Now, back home here, the sale of that particular asset is also subject to Australian tax. However, as the asset has been held for more than 12 months, a 50% capital gains tax discount was available, meaning only half of the gain is subject to Australian tax. Now, notwithstanding that only half of the gain was only taxable here, the taxpayer was seeking to claim 100% of the US tax paid as an income tax offset. The tax office obviously didn't like what they saw and denied the claim, and the case was made its way through the courts. So cut to the chase. What do we know? Well, now the final position is that if only half of the gain is taxable, say because of application of a CGT discount, then you're only entitled to claim half of the tax paid as your foreign income tax offset. Now, obviously, the tax office has come out very quickly, welcoming the decision, saying this is how the law is supposed to apply from day one, and the case simply clarifies the legislation. The tax office is also announcing that they are going back, looking at disclosures from taxpayers in the past to make sure the foreign tax offset calculation is correct. And on that note, the ATO is inviting taxpayers to review past claims to make necessary voluntary amendments. So if you have disposed of an asset overseas in the recent years and have claimed on foreign tax offset, it would be a good idea to get on the front foot and check with your tax advisor to make sure the tax calculation is correct. Now, if you like what you have just watched, please like our video below and subscribe to our channel so that you will be notified automatically of future videos. Now, question of the day. What do you think is the 3 most hated tax by businesses? Tell me what you think and I'll review the answer in the description below. And see you at the next video.